After that huge run-up we saw in November, the market has kind of hit the pause button. We're just hovering right below those all-time highs. It's got that quiet, tense feeling, like when you're at the very top of a roller coaster right before the big move. So where do we go from here? Let's get into it. And believe me, it really is. This past week was one of the quietest we've had in a long time. But, that's not necessarily a bad thing. Think of it as a healthy breather, a consolidation. It's where the market just chills for a minute, letting buyers and sellers find a new equilibrium before whatever comes next. And here's just how close we are. The S&P 500 is sitting just 0.6% below its one-year high. That's it. We are right there at this super critical point where things could either blast off to new highs or pull back. You can almost feel the tension. All right, so here's the game plan. We're going to break down this big pause, look at what the Fed might do next, and check out the final scores from earnings season. Then we'll put a few stocks in the spotlight, see what the buzz is with BlackBerry, and wrap it all up with what you need to watch for next week. So let's kick things off with what happened this week. After the monster rally we had last month, seeing the market just trade sideways is actually a pretty good sign. It's kind of like it's building a solid foundation before it decides to make its next big climb. And yeah, the major indexes were, basically flat. The S&P 500 barely squeaked out a gain, and the Nasdaq was up just under 1%. It really just hammers home this idea of a quiet week, like buyers and sellers are in a standoff, waiting to see who blinks first. Okay, but here's where it gets interesting. If you peek under the hood of the market, there was definitely some action. Tech stocks just kept on leading the charge, up 2.4%. But look at the other side. Utilities, which are usually a safe haven, got slammed, down 4.5%. That tells you investors are still feeling kind of risky, favoring growth over safety. For now, anyway. So, if everything's so quiet, what could possibly shake things up? Well, all eyes are on the Federal Reserve. Coming up, we've got a fresh inflation report and another big interest rate decision. And honestly, the economic data is sending some seriously mixed signals. And this right here, this is the question on Wall Street right now. For months, the job market has been super strong, which has given the Fed all the reason it needs to keep rates high. But are we finally starting to see some cracks in that armor? This slide shows the Fed's problem perfectly. Look at this. On one hand, you've got U.S. companies announcing 1.17 million layoffs this year. That's the most since 2020. That screams weakness, right? But then, on the other hand, weekly jobless claims just dropped to their lowest level in 3 years. It's a total contradiction, and it puts the Fed in this classic damned if you do, damned if you don't spot. It's why their decision next week is going to be such a nail-biter. So, while the big economic picture is, let's call it murky, the picture for corporations is actually a lot clearer. We've just wrapped up the third quarter earnings season, and the results, they've given the market a really solid floor to stand on. Okay, get this. A whopping 83% of S&P 500 companies beat their earnings estimates. Now, just to give you some perspective, the long-term historical average is way down at 67%. So yeah, companies are doing really, really well. And that strength is a huge reason stocks have held up. And it's not just about looking back. Wall Street is feeling pretty optimistic looking forward too. Analysts are actually forecasting a very solid 15% earnings growth for the full year 2026. That kind of confidence about the future is a really powerful tailwind for the market, as long as companies can actually pull it off. All right, so we've talked big picture. Let's bring this down to earth. How did all these market trends actually play out for some individual companies this week? Let's take Dollar General. It was one of the best performers in the S&P 500 this week because it totally crushed its earnings. And this quote tells such an interesting story. It wasn't just their usual customers shopping there. Higher income families are now trading down to find better deals. It's a fascinating peek into the consumer's mindset right now. Even people with more money are feeling the pinch. But it's not always so straightforward. Check out Cooper Companies. It's a perfect tale of two stories. The bulls look at it and see earnings going over 21% a year. Awesome, right? But the bears point out that their profit margins just slipped. And that's a perfect snapshot of the whole market's tension right now. A bright future clashing with a challenging present. Okay, now for something a little different. Let's switch gears and look at a story that's being driven less by spreadsheets and more by social media. Let's talk about BlackBerry. This quote from a user on a popular Reddit forum pretty much sums up the whole idea. Retail traders have noticed this pattern where BlackBerry stock seems to rally in the couple of weeks right before it reports earnings, so they're all getting ready for it to happen again. So, how does this actually work? Well, they're hoping to trigger something called a short covering rally. Basically, if the stock starts to tick up, all the people who bet against it, the short sellers, get nervous and have to buy shares to cut their losses. But that buying action just pushes the stock even higher, creating this kind of feedback loop. It's a really high-risk, high-reward play that's all about momentum. Okay, so let's pull all these threads together. You've got a market that's paused at the highs, a Fed with a really tough call to make, and a pretty strong earnings season in the rearview mirror. This whole setup could make for a really explosive week ahead. And the calendar is absolutely packed. We've got 3 huge things to watch. First, the new inflation data, which the Fed will be watching like a hawk. Then, the Fed's rate decision itself. And if that wasn't enough, we've got big tech earnings from giants like Oracle and Broadcom. Literally, any one of these could be the spark that moves the market. Which really brings us to the final billion-dollar question. After this big pause, this calm before the storm, is the market going to break out to new all-time highs, or will the news next week cause it to break down? The answer is probably going to set the tone for the rest of the year.